Good morning, Manny. Nice to see you once again and touch base on Flagship and Global Masters. Just looking at the date, Manny, yesterday being Tuesday, first day of the month, interest rates, if I look at the actual numbers, goods inflation is coming down, but services inflation still seems to be quite sticky. Just looking at the recent pause by the RBA, they've kind of been foot on, foot off more recently in the last few months. What has been the impact on the companies that you're invested in from the rising interest rates? And do you think we're coming to an inflection point for some of the headwinds that might have been placed on those growth stocks?
Oh, I mean, absolutely. It's been a year of sort of two halves if you go back 12 months. The first half, growth stocks were absolutely on the nose because of the rising interest rates, and everybody was sort of saying it's the end of growth. The last 6 months has been a very different place for us to be, and that's because the true quality of the companies and their earnings, their ability to grow earnings, is coming to the fore. I mean, it's no longer just the valuation and hitting the valuation down because of the increase in the discount rates or whatever. That seems to have played out, and now the discount rates are stuck where they are, even coming down. And now you've got these massive growth in earnings coming through or being alluded to by the companies ahead of reporting season, where they were updating their numbers. And that's been the case for the last 6 months, which has been a really good place for growth stocks. And more importantly, in the last sort of month to 2 months leading into reporting season. And that's what we've been saying in all of our dispatches, is that we've been obviously affected by the increase in interest rates or the increase in the perceptions. Discount rates have gone up. Growth stocks have been on the back burner. That's over. People were waiting for it to turn. They blinked, and actually it's all happened. So I still think there's a lot of way to go. But certainly in the last 6 to 7 months, we've been on the right side of the ledger.
Sure. Just thinking about that reporting season that you mentioned coming up and some of the secular growth, and I guess focusing more still domestically for this point in time. I know the Flagship Fund, you are quite heavy in terms of the under and overweights from a sector perspective, which is quite good. It looks very different from, say, your standard ASX 200 or other benchmark. Yeah. What sectors are you most overweight or underweight at this point in time? And what sort of companies are you looking at quite closely, whether it be what's exciting or what you're expecting coming into reporting season?
Yeah, so we don't, honestly, we don't look at it from a sector perspective. And I can't remember when last I looked at a chart that had the GICS classification, because it's not something we focus on. We try and pick the 30 best companies that we can find, and we pick the best company in a particular industry. So we'll look at, if we decide we want to own a bank, we will figure out which is the best one and why, and that's what we will put in the portfolio. Unless there's some reason behind us adding some player to that space, we pick one in the industry. And so we don't have a sector bias, or, I mean, you might sign 3 or 4 stocks in a certain sector because of GICS, but that's just because of the GICS classification. It's got nothing to do with the business. If you have a look at the underlying business, they'll be totally different, sort of like car sales, and I think Seek were in the same category for a while. Those are 2 totally different businesses, but yet they're in the same sector. So we don't even look at that. It's all about the underlying business and how it competes, how it's competitive, how it competes with other players, and we try and get the best one out of that particular analysis.
Sure. Something that stood out to me, and I'm not sure if you've seen similar observations coming up into earnings, but there seems to be a large disparity or bifurcation even in terms of consumer spending or consumer discretionary. It sort of seems as though maybe only a small cohort really has been affected by the policy changes. For instance, like a Kathmandu might be killing it at the minute, and then on the other side, a North Face is losing, almost like a zero-sum game. So it seems to be very barbelled. How do you interpret that? Is it all that it seems, or would you have anything there to add?
Well, as you would know, I was in the press about a week ago talking about Lovisa and a couple of other stocks. And the problem, as you just pointed out, that you've got consumer discretionary spending. All indications are that the consumer is winding back, and we know that they're under huge mortgage pressure. And if they're not yet, they soon will be as we get over that hump of mortgages being refinanced. So the consumer, in terms of his dollars, is cutting back because he's got to put food on the table and pay the mortgage. So if you're in that space, it is kind of like a zero-sum game. They're either going to buy a shirt from A or a shirt from B, or whatever it is they're buying. But if you can find a player in that space that is expanding their economic footprint in terms of store rollout, then in spite of same store sales maybe declining or staying the same, as we said, because it's a zero-sum game, and hopefully expanding it compared to the competition, if they can increase their stores by 10% or 20% in a 12-month period, that's what we're looking for, and that's what helps us in the current environment. And when that should turn, then you get that plus the increase in consumer spending, which feeds through and gives you the double whammy. So particularly when we look at Lovisa, they've got a global footprint. And the interesting thing with that company is that while COVID was with us and we were all confined to barracks, consumers weren't spending, particularly in stores, which is the way they primarily sell their product. And a lot of their competitors were going out of business. So they were getting key sites and beautiful sites that they could never get their foot on because the competition were going out of business. And they tied up those leases during the COVID environment. So they've been able to expand the number of stores in spite of what's happening to same store sales. And that's the dynamic that we focus on. I mean, years ago, JB Hi-Fi was the same. Consumer spending at that era was declining, but they were adding their stores at a fast rate. And that's what actually improved the economic footprint that we always look at. And that's what added to not only the EPS growth, but obviously the share price growth commensurate with that over time. So that's how we look at that particular space. We need to find a dimension that's outside of consumer spending that's going to give us the growth in earnings. Otherwise, what's the point?
Sure. And does Lovisa have many peers at the moment? Do they trade at similar levels and have similar EPS growth, or are they really the only ones winning at this point in time?
No, I mean, the analyst that covers it internally for us will obviously look at all the competitors. That's part of the research process that we go through. And if we feel that one of the competitors is better, then we would go with the other competitor. But that's part of the analysis that we do. After that in-depth analysis, which gets posted or presented to the investment committee meeting, we were happy with that assessment and we ended up putting our foot on Lovisa. So that's the process that we follow.
Yeah, great. Okay. How about shifting tracks a little bit to overseas now? What's happening globally? Could you just step us through the performance of GFL, as we alluded to off air? You can sort of pick the acronym you'd like to coin at the minute, but your Magnificent Seven, your FANG stocks, it's certainly been very top heavy with what's been driving returns. Have you seen that playing out over the past 12 months and then 12 months looking forward?
Well, as you will be aware, the board took a decision some time ago that it wanted the portfolio to be more actively managed than what it was, because it was purely a passive holding in Berkshire Hathaway. And with that gentleman and his right-hand man, Charlie Munger, getting on in age, one has to be a bit concerned because you've got no real background on the potential successes and how they're going to go. And when we look at companies, one of the key metrics is how long have the management team been there, and can you point to their performance? And if both of those, the management team have been there for a long time and there's a succession plan and they have performed over the past 5-10 years, well, then we run with it. But if all of a sudden there's a new management team, well, you've got to walk away. So that's been the concern with regards to Berkshire Hathaway. And so the board decided that it wanted it to be managed in a more active way. And we agreed to do that. Then, as we were talking about earlier, we formed an ICAV, or a UCITS, out of Ireland. And we went to the board and said, listen, you want us to actively manage it. We've set up this ICAV in Ireland. We're prepared to give you a fee holiday if the capital that you were going to ascribe to us to manage in an active way goes into that entity. You'll get the same stocks, obviously the benefit of that, but you'll get the benefit of it being managed actively at a zero management fee rate, which was very attractive to the board. So it helped us, the manager, get additional seed capital into the ICAV, which obviously gives it critical mass. And the Global Masters Board got an active manager doing it for nothing. So it was a win-win for everybody. And that's been going particularly well, as I said, particularly in this environment where growth stocks are coming back to the fore and have had the advantage of outperforming the value chain.
Only other thing I'd add to that that we haven't touched on yet is the unsecured subordinated notes with that conversion trigger built into, raising some additional capital without having really big leverage. I mean, LICs don't generally have debt facilities, but I find that they're quite an equitable way to raise money without diluting the NTA. And then, you also have some opportunities on the upside. So for investors that participated, how's that capital being allocated? And then even for those that maybe want to get in, how do you see those types of securities, particularly in an environment now where you might have a discount that's amortized based on how the notes are trading with that call option? Sorry, a bit of a loaded question.
Yeah, look, honestly, we put our own money into the convertible notes when they were on offer because we thought they were a great investment. When they were offered to the market through Bell Potter and others, we only had the offer open for, I think in the case of Global Masters, for just short of 2 weeks, and in Flagships it was open for a couple of days. The demand was huge, and that was because there were no really decent yielding plays around at that point. And as you know, when you go into a convertible note, it's all about can anything go wrong, and if it does go wrong, do we get our money back? And one's got to be careful in a number of instances because you don't know whether you're going to get your money back. It might be a miner that's got a hole in the ground, or it might be somebody developing a new product. But in both Global Masters, Flagships, and in ECP, the assets are listed equities, and they're quality listed equities. And in the case of Global Masters, it's Berkshire Hathaway. So you have to say that if there's a point where the investors want their money redeemed, the sale of Berkshire Hathaway will happen in 2 seconds flat, and the money gets returned. So there's no risk to the return of the capital. So then you're getting the yield, the interest rate that you buy in at, and it was very competitive. And in fact, both of those entities, it ratchets up to 6.5 in 2 years' time. So you can't say there's no risk attached to it, but certainly there's very little risk given the backing that is behind these notes, and you can redeem them at the end of the period. So if you want to convert them, you're going to be converting into listed equities, which are trading at the share price that you're going to convert at is trading at a massive discount. So I think that not only have you got the option of the upside, as you said, but you've got the guaranteed return of your capital because the assets are sound, and you've got a fabulous interest rate in the interim. So to me, it's a no-brainer. It's a lay down misere, and that's why we put our own money into it.
Yeah, I'd agree. And even in terms of the interest rate that you're receiving, it probably looks quite interesting now when you look at the swap curve and how much that has flattened out, particularly, as we said, with the last few rate increase and pause and so on. Yeah, if it's trading below $100 especially, then there's upside even before you come into that call optionality that's baked in, particularly when you're looking at 6% and that's probably a good 2.5% premium if we reach a terminal rate of somewhere between 3 and 3.5%. Only other thing I might ask, just looking at company specifics, aside from Lovisa, is there anything else that you're really excited about coming into this reporting season? Maybe even that you think the market isn't appreciating?
So in answer to that question, Hayden, I'll just refer you to an interview that the Fin Review conducted a little over a week ago. In that article, I did cover a couple of stocks, which was GQG and Megaport, and I've spoken earlier about Lovisa as well. But as you will be familiar, what we do is we calculate daily the internal rate of return. So when the share prices move, and you'll have seen the movement in some of those, so we then adjust our weights accordingly. But what I'd rather prefer to talk about is the actual LICs and the share price around those, as opposed to talking about individual stocks.
Yeah, great, because they have bounced and quite materially. So then, Manny, in terms of the LICs, what are you seeing or thinking there?
We think that when you look at our overall portfolio and then you look at where the share price of both those entities is trading, I don't think the market necessarily appreciates the quality of the underlying investments. But that's also, I think it's also a nature of the size of both of them, and that's why we did the convertible note issue. And it seems to me like the magic number is 100 million. And hopefully, if we perform like we have in the past, Flagship should be over that within 12 to 18 months, and that gets us into the realms of reasonable size and liquidity. GFL, there's a bit of work to be done, as there is an ECP, and that's the overhang that causes a slightly bigger discount, because clearly we've done some work, and if you're a big LIC, you don't necessarily trade at that discount. So that's what we're trying to get rid of, and that's the only metric that I think makes any sense is the size. Buybacks and the rest of them, Scotty, the company secretary, did a really interesting paper on what's happened with people that have done buybacks, and we know that once you stop the buyback, it just returns back to where it was. So the market has got a level that it's happy with, and that the major determinant of that seems to be size, and we're working on that.
Yeah, spot on. I'd echo that. I mean, from my side, seeing even the most liquid and high in terms of market capitalisation, even those companies are trading at a discount. So right across the board on the sector, and I think it's just a lack of buyers at this point in time, as we mentioned before. Yep. Equity markets still seem very, very antsy. I mean, bond market volatility has been very, very high as of late, but the equity markets, by comparison, have been quite a bit more muted. So I think a lot of people still sitting on cash, still being a bit unsure. But look, therein is the opportunity, I would say.
Yeah, absolutely. And I mean, I know you do really comprehensive research into the LIC space, but just one thing that struck me the other day is I was obviously thinking about, as I am on the boards, of dividends and the dividend cover and what we're going to pay out. And I was gobsmacked with some of the really big ones have had no dividend increase for like 3, 4, 5 years, whereas Flagships and has continuously increased its dividend, as ECP. And I thought, wow, that's extraordinary, because I would have thought in the small to mid cap space, if you were a value manager, you would have certainly had the opportunity to increase the dividend. And if you're a growth manager, well, yes, you have, and we certainly have. But the competition haven't been doing that, which I find extraordinary. I think it's because a lot of them were paying dividends out of the capital gains that they were realizing, and those just haven't eventuated in the last couple of years.
Yeah, and look, that can be difficult, especially when you have quite volatile markets based on prior period profits and what you're able to pay out. So look, I'd agree. Investors definitely appreciate, not to say the certainty, but a high degree of confidence in the trajectory and growth of dividends. So I agree with you completely there.
Yeah, and we've been fortunate that the companies that we've invested in have been increasing the dividends, and we just flow that straight back to the investor. So, and I don't think we've made a big enough noise about that now that I'm thinking about it. So I'll get my digital media people to get on the drum.
Sounds good. I'll watch out for that campaign. All right. Thanks for your time, Manny. Just looking at the clock here. So just would like to thank you once again for allocating some time out of your day to have a chat with myself.
No, pleasure. It's always a pleasure. And thank you for your interest in our companies, and anything we can do to help, just let us know.
Great. Thanks, Manny. Cheers.
Okay. Cheers. Bye.